Hello, everyone. Welcome to another video. This video is actually going to be about capital appraisal techniques, or it's also called investment appraisal techniques or capital budgeting as well. This is nothing but if I have to explain this in simple terms, it's if a business or you yourself are investing somewhere, then you need to look at the rate of return, right? So you're trying to understand the rate of return using different techniques. So few techniques that we are going to look in this video would be payback period and net present value. I would also try to cover payback value, payback period with time value of money, including time value of money, which is called uh, payback period net present value. It's a combined technique, but to in this video, the focus would be payback period and net present value. So let's get started with this video. And other reminder would be that if this video you think would have been helpful to you, please don't forget to subscribe to the channel because it helps keep a person motivated to make videos like this. So let's get started with the video. We have this company called ABC, which is a fictitious company that I created apparently. And then you can see that the company actually wants to invest in a project. You can read through the question, but I will also uh, pinpoint the important areas of the question. So the important areas of this question would be we are given cash flow or profit and losses. Actually, it's not cash flow; it's profit and losses because cash flow is different than a profit or a loss. So we are giving profit and losses for 5 years here that you can see. And then investment at the start of the project would cost 150. So these are fictitious number again. You can add thousands or you can, but for the sake of simplicity, I have kept it very low numbers. So 11, 30, 34, 47, 45 is the profit. Loss is represented by a negative number. So first year is actually a loss. And then the investment will cost the company about 150. And the investment sum assuming nil disposable value, which so meaning it doesn't have any disposable value. Uh, After 5 years would be written off using straight line method, right? So this is again an important information because it's going to help you calculate the depreciation. So whenever we do capital appraisal or capital budgeting, we have to look at the cash flow, not the profit and loss. So that which is why I said there's a difference between cash flow and profit and loss. So we are going to add back this depreciation number back to the profit and loss because as the questionnaire says, the depreciation has been included in the profit estimates above, which should be assumed to arise at each year end, right? So basically, what if you know about income statement? So income statement gives you profit and loss, and in that depreciation is already deducted as an expense. So we don't want that. We need to add back the depreciation into the profit and loss to get the cash flow, and then we will calculate the payback period. Right. The reason why we do that is because depreciation is a non-cash expense. Company never or doesn't pay any depreciation expense to anyone. It is just to account for a decrease in value of a fixed asset or an investment project. So this new project could also be an investment in a fixed asset. You can see it as that way as well, right? Maybe they're purchasing a machinery which has a value of 5 years, and it's going to be depreciated over 5 years using straight line method, right? So the straight line method is very simple, right? So you are given cost of the asset is 150 and life is 5 years. So depreciation in this case is going to be nothing, and there's no residual value as well. So it's just going to be simply 150 divided by 5, and that will give you a depreciation expense of $30 every year, right? So we have depreciation expense of $30 every year. And now we will take these numbers here, we will copy paste them here, and then add uh, let's say we add a column here, add depreciation, and then let's call this column as cash flow. So depreciation is 30, right? Depreciation is 30. It's going to be 30 for all 5 years. If you want the numbers to be in center, we can do that as well if that's more convenient to read. And now it's simple. We just need to add back the depreciation here, right? So we just do that. Let's autofill it as well, which is a great function. And now this is the cash flow, right? So this is what company will make each year. And the company needs to recover the company. So in payback period, the company is so payback period is very simple. In how much time period? So payback period is basically, if I have to define, I can write it here. Payback period uh, is in how much time the company can recover the cost of investment. Right. So it's basically that. So you need to understand when the company would be able to recover its $150, right? $150. So when the company would be able to recover its $150 is, so in year one, it's going to receive 19, right? So in year one, total cash flow, we can call this column as total cash flow. So in year one, 19 is received. In year two, it's going to be 19 plus 60, so 79 is recovered. And then in year three, 79 plus 64, 143. So we are still away. So we still need $7 more to reach 150, right? But the cash flow for year four is 77 is 77. So I only need seven more dollars. I only need $7 more here. So it's going to be 3 years. So it's year one, year two, year three. It's going to be uh so total recovered is two. So total recovered I have is 143. I need $7 more. So the payback period here is going to be 3 years something. Right. So that something could be calculated by 7 over 150, 7 over 150. Right, I need $7 more here. Let's call this this, because this is a cash flow column. So 143 plus 7. I have this 150. It's recovered. Now it's going to be 3 years. 3 years, 7 over 150. So it's going to take. Let's add it into this actually, and then it will be 3 plus something. So it's basically 3.04. So 3 first few months of year four, basically. So this would be the payback period. Um, payback period. Payback period for this investment. Right. So now it tells you that the company will take around 3 years. The company will take around 3 years to recover its money. Um, Again, company should have a benchmark. What would be acceptable here? We can't make any decision, right? So if you have to make any decision, we cannot do that. So whether would you like to invest in this project or not, there's no reason here. We cannot justify a reason here because there's no benchmark in the question given. So let's say we assume that the company would like to have a payback period of 2 years, right? So let's say we extend this question a little more. Let's say the company has the company would accept the project if the payback period was 2 years, right? So if the payback period was 2 years only, then the company will accept the project. So in this case, this is more than a little over 3 years. So in this case, the company will not accept this project under payback period, right? So which is why it is also important to do this analysis using other methods as well. There are other capital appraisal techniques as well, like accounting rate of return, internal rate of return, which will not be covered in this video. I will only focus on two methods here. I might add one more method using net present value for payback period, but in this video, it's only payback period and net present value. But let's see, I might include the net present value part in the payback period after we have covered the net present value as well. Right, so 2 years, let's say company wants it to be 2 years and it's 3 years, company is not going to accept this project. Now, if you would like to play with the variables here, so let's say let's say the company increases its cash flow, right? So let's say we change the numbers here a little bit, and then the company earns its cash flow a little faster, then the numbers will change. Right. But right now we are not going to do that either. But if you would like to play with variables, you can actually play with the variables. I might drop a link to this worksheet uh, so that you can download and play with the variables and understand the formulas here as well, right? So in this case, we will move on to the net present value now. The payback period here, I will highlight this as well, so it's easier to right. So payback period. So this would be the answer. This is the payback period for this investment, right? So let's move on to the net present value. I will make a note here as well. Decision ABC Co will not accept this project because the payback period is more than 2 years, which doesn't meet the company's payback period benchmark. Okay. Let's move on to net present value. So in net present value, again, we are going to do the same calculation. We would need the cash flow, right? So it's not going to be based on profit and loss. So to save time, I'm going to get these numbers from here. So this would be the basic start for us for sure. And another thing that we would need in this case is actually uh, a discount rate. So let me add another row. So control the zoom and let me add another row. So I want a discount rate, which we will use as, let's say I decide at 10%. Right, so net present value is nothing but so net present value, we need to first calculate the present value of these cash flows, right? So if you have, if you are familiar with the concept of time value of money, then you will understand what present value is. I'm not going to explain what present value is in this video. I already have a video on my channel which explains time value of money and how to calculate future value and present value. There's a separate video for that as well, so you can go and check those videos there. But if you have already, if you have been an accounting or finance student, if you have studied accounting or finance before, so you are pretty much familiar with what present value is. It's nothing but calculating the current value in today's time. So at time zero, what is the value of a certain cash flow? So basically, a dollar today is worth more than a dollar tomorrow. It's because of the inflation, right? So over time, inflation goes up, and the value of money declines over time as well, right? So in this case, first to calculate the net present value of a cash flow, we have the cash flow, which I have explained this before in payback period method, how we calculated cash flow. Now we will calculate the present value, for which we need the discount rate. Which is 10% in this case. And then we can actually use formula, present value formula in this case. Our rate is 10%, so I can just refer it to this cell, 10%. And then number of periods, so this would be my number of period, which is year one. Payment amount, which is 19. No, actually, payment amount in this case would be 0, because there's this payment actually refers to the actual payment every year. And then cash flow is 19, future cash flow, future value, and end or beginning. So I will say 0 for end. If you want to do beginning, it's 1. But there's a difference between end or beginning. Again, you might have to go to another video where I have explained time value of money, along with how to calculate present value and future value using Excel. Right, so in Excel, we already have these built-in formulas. which you can use. So that's a great thing. So we will calculate this. So this will give me the present value as negative 17. So it's worth so $19 is worth negative 17. The negative is because we can it's going to come at the year end, right? So 19 will come at the year end. So you can remove that negative by putting negative there. Uh, and we will repeat the same. We'll repeat the same. So rate is going to be 10. Actually, if I can just use the same formula here because we can fix this value. You can fix this value and the others will automatically change. Right, so um, that's my cash flow for each year, the present value of cash flow each year. Now, what is net present value, right? So this is present value, not net present value. How do we calculate the net present value, right? So um, cost of the asset was 150, right? Sum of PV, which is present value. So I can do sum here and add all these numbers, right? That's 214. Now, net present value, net PV would be minus 150 because that's a cash outflow plus the sum of present value, all the present value, which is a cash inflow. So net present value is $64. So in other words, it says that from accepting this project, company ABC Co. expects to make or gain $64.10 in cash flow, right? So it's a positive number. The decision here would be accept the investment project because NPV is positive, right? So in net present value, the decision is only based on positive and negative. If the company's net present value is negative, if it's the company's net present value is negative, then do not accept the project. If it's a positive, then accept the project. So again, if you want to play with the variables here, so let's say I make this, uh, minus 10, and then this also as maybe minus 5. Right now, we are very close. So now numbers will automatically change because we have used formula, right? So let's say I only make $1 in year 4 uh, in profit, but even though the cash flows, so you see cash flows is always is still positive, positive, positive. But still, the net present value of this project is negative, and in this case, we will not accept the project, right? Right, so let's go back to our original numbers that we had. In this case, we will actually accept the project because it's a positive number. So let me also go back to explain. So one of the drawbacks. So another method that I would like to cover in this video would be another drawback of payback period. One of the drawbacks, a very common drawback that they mention is that this cash flow doesn't consider present value, right? So this cash flow doesn't consider present value, right? So now what we need to do is we will use a discount rate as 10 again. We have already calculated the present value here. So the present value of the cash flow looks like this, right? So we will take this number here and put this here, copy this here. Let me just copy the values actually instead. So because it's also uh, copying paste special and I want the values only. Right, so we have using the discount rate that we have done before, right? Now this is the actual cash flow, right? So now we will calculate the total cash flow to calculate the discounted payback period, right? So we can call this as discounted payback period as well. Actually, this is called discounted payback period. So payback period, and I will add another term here, which is uh, discounted uh, payback period. So two methods. So right. So payback period we have already covered. Net present value we have covered. Now this one is going to talk about discounted payback period. Now let's type out the total cash flow, total cash flow here, right? So in year one, it's this. Then in year two, the company would have received this plus this. Then in year three, it would be this plus this. Then in year four, it will be this plus this. So we see now the payback period has gone up. It's going beyond year three. So we are already at year four. So so we would have so in year four it would meet sorry, so it won't go beyond 4 years because the investment amount was 150, right? So in year four um it will touch that benchmark. So how much do I need? That would be the question here, right? So how much do I need? It would be 52. I need this much, right? So my payback period can be add 3 as well because it's going to 3 plus something, right? So it's slightly more. It's slightly more. Um, compared to the payback. So it's 3.23 something years, right? Again, the company will not accept because the benchmark here is 2 years, let's say, until and unless the company adjusts the benchmark period. So generally or normally speaking, you won't see companies actually using a payback period or discounted payback period very often or to make their decisions. It would really depend. This is a very simplistic calculation, very simple, doesn't take a lot of variables into account. That's why net present value is much more popular and comprehensive as well in terms of decision making. And there could be many more other variables as well, right? So I hope this video was helpful to you. Again, just to recap, we have covered three methods in this video about capital budgeting or capital appraisal. The first one would be payback period, then discounted payback period, and the net present value. So I hope this video was helpful to you in understanding these three methods for capital appraisal. And if you think this video was helpful to you, please don't forget to subscribe to my channel and like this video as well. And please feel free to comment as well for more topics or videos that you would like to see from my side. I would be very happy to make them as well. Thank you very much for watching this video.